What's up, everybody? Welcome to the Mortgage Coach Friday Mastermind. Every Friday, 9 o'clock. We are here to bring on experts, leaders, authors, top producers. And in this case, we're bringing on an industry icon, Dan Rawitch, Mr. Market Update. Dan is a market, market visionary. If you want to be an expert at what's happening in the marketplace and how to transition that into better advice and better conversations with both borrowers, realtors, and any type of financial advisor, Dan Rawitch is the man. He has been our chief economist for, Dan, how many years now has it been that you've been the chief economist for Mortgage Coach?
14.
14 years, guys. And how many years have you been a market nerd?
40.
40. So 40 years, we're not going to go through the whole story, but
that can't be possible. You look too young.
Oh, I love you. What are you doing later? I'm 63 years old. It actually
No.
Yeah, you do not look a day over 40, brother.
It's the filter. It's the camera filter.
Yeah, right on. So guys, this is going to be about the 2022 update, but let's face it, the past few weeks have been a little bumpy. So we're going to try to tell you, Dan's going to give you some perspectives on what's happening past few days, what might be happening next few weeks, next few months. And then I'll try to pull out of him, what's his prediction for the year and what that means to you strategically as a mortgage professional and as a leader of mortgage professionals. We also have Tina Bradford, who is a success coach at Mortgage Coach, and her job is making loan officers successful. She's got a lot of large enterprises that have enterprise relationships with us where they get Tina or another one of our success managers. And she's going to show you guys how to be using Rawitch more strategically. So we're going to do like 3 chapters. Dan gives a little update. Tina comes on and does a little bit of Rawitch how-to. And if you have questions, put them down below to help facilitate this mastermind conversation. We have the one and only Mr. Win by Noon, Todd Bookspan. What's up, brother?
Hey, not much. I just realized if Dan's been doing this for 14 years, that means I've read over 700 daily updates that Dan has done. So how cool is that, especially with his daily thought, which I always love to read. And, Dan knows I'm a big fan, so I'm excited to be here. I'm a part of his market mentorship program, and I've just totally enjoyed being in there as well. And not only getting to see what he does in the mortgage coach community, but also getting his weekly video update of what's going on in the market.
Yeah,
thank you so much, Todd. What are you doing later?
Yeah, right. So,
we got D-Bird too. So let's make sure we let's get Miss Social Media plugandplaysm.com, Deborah, who already spoke up, but let's at least say hello.
Well, I'm really excited because Dan, this is my weakest area. So I'm glad that I will officially be a part of the Cool Kid Club and get your daily updates. And I have a lot to learn, and I'm excited because this will help the clients we serve. And so I'm ready to take lots of notes. I'm excited. And I'm excited Tina's on this call because I get such great feedback. Tina, I haven't personally been able to tell you that, but my clients who have you as their account executive, like they rave about you. So thank you for what you do for Mortgage Coach. And I'm excited to be on this call.
That's really nice of you to say that. So Todd did say something that I think is really important. Anyone listen to this is Dan does a daily update. So it's less than 5 minutes. It's usually, kind of a 3-minute target. It is available through Rawitch. We'll show you how to see that in a bit. It's also available in our Facebook group, Mortgage Coach Productivity Mastermind. So just make sure, write that down right now. Like if you're not listening and watching that Dan's daily update, it's a mistake. And if you're a new loan officer, in the new loan officer playbook that Todd and I are co-authoring, it's already available in our YouTube channel, or already available on my LinkedIn. Like that's something for the first 90 days you're in the business. 2 things that Todd and I both agree is that you should watch every week the "What's Your Rate" interview that we did so that you can answer that question confidently. But you should watch that Dan Rawitch morning update every day. Now, there's a good argument to say for the rest of your career as a mortgage professional, you should listen to it. But if you just watch it for 90 days straight, then you can decide how you want to prioritize it. So Dan, we're 5 minutes in. I give you the stage, brother. Give us your update.
All right. Thanks, Dave. I appreciate that. Thanks for the intro. Thanks for joining us, everybody. I got to share my screen first. Sorry, guys.
And remember, if you're watching this live in Zoom, put your link or any questions you have. I do want to remind anyone watching this in Facebook or Zoom, we have changed our process. It used to be that you'd sign up and you'd have a link for every Tuesday, and you'd just have that. We had a lot of people that said, hey, it's noise. I don't want it every week. So you have to now go to our website. I'll show you how to do that later in the call. And if you want to be in the Zoom audience, you got to come in and sign up. But it does go into our YouTube channel every day. So, an hour after this is here, it'll always be in our YouTube channel, and it's always live in our Facebook group. So that's another thing. Just get used to 9 o'clock on Fridays, 9 o'clock on Tuesdays. It's in our Facebook group. So check that out. All right, Dan.
Okay. Thanks. Okay, so just a quick frame what I'm going to talk about today. As Dave said, three chapters essentially. The first chapter is, I guess, a little bit of a nerd topic. You could argue everything I say is, but there is something called M2, which if you didn't sleep through economics, if you took economics, M2 is all of the money circulating in the United States. It's literally the value of all money. And then attached to M2, there's something called the velocity of money. And I'm going to talk about how those two things are the number one factor in determining whether we're going to have real inflation or not. And by I mean real, I mean sustainable. That's chapter 1. Chapter 2, it could come off as sort of a negative doomsday type topic. And I'm not talking about interest rates, believe it or not. I'm talking about something else, dealing with these time cycles. And if you followed me for any time at all, the strong belief I hold in cycles. Cycles are a real thing. I could prove them to anybody that wants to discuss them after the call. I may not have time to go into all of the proof about cycles, but if you followed me, in fact, the call before last on Mortgage Coach, we literally called the very top of interest rates before a very long drop. And that was because of time cycles that were coming together on a specific day, going back over 300 years. So these things are real. Nobody understands why, but they are. So I'm going to talk about some cycles that are coming together in 2022. It is going to be sort of a strange year, but I think it has very positive implications for you all. And then last but not least, probably the thing you care about most is where are rates going, in the next few months, and then where do I think they're going to be at the end of the year. So those are the 3 chapters. And I just want you to remember these 2 things. The math is always wrong. So whenever you're investing, you need to ask yourself, what is the math believing, and what are the lemmings all following today? Because you don't want to be going in that direction. It was the very first thing my very first business instructor said in college. It was one of those seminar type classes, or 300 people or so in the room. And he wrote on the board, we didn't even know who he was yet. The math is always wrong in big letters. And he turned around, he shouted, follow that and you'll always be successful. Not the math, but what I just wrote. And I've lived my life by that from day one. And then lastly, things are never seldom. Sometimes they are what they seem, but they're seldom always as they seem. And that's kind of the theme here today. So let's start with this M2 concept. So again, we mentioned M2 is the value of all checking account, savings account, money markets account, all of the money in the country. And as the Fed, it was stimulating and all these, what do they call those, Jen, with the pandemic, stimulus payments, M2 just kept rising and rising and rising. And everybody's been saying there's a long-term belief that when the Fed pumps money into the system, it's inflationary. It is not. It is actually deflationary. And that's proven by looking at the velocity of M2. So the velocity of money, meaning how much is money moving around? If it's swirling around the economy and you're spending it, and then I'm spending what you spent on me and blah, 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 then we get money velocity going through the roof and inflation becomes unsustainable. It becomes too high. It can't sustain a low level. You can see what's been happening to the velocity of money really since the Fed started increasing his stimulus. Money's not going anywhere. And especially after all this huge amount of stimulus, money velocity just really went just down hard. So this is M2 yearly growth as it relates to inflation. And where'd we go here? I forgot which line is which. So the black line is the growth of M2, and the red line is inflation. And you can see that many, many, many times, even when M2 grew, inflation fell. And so they don't necessarily go together. This was a very strange period right here, and that's not so much the focus. And then you can see as money supply grew, sorry, this is, hang on, I got my own self in my way here. So this is money supply versus the CPI. So as money supply has grown, you can see that to a certain extent, GDP has grown as well. So the Fed has helped himself to a certain extent. Okay, why printing money won't create inflation? For the last 12 years, the annual refrain from economics has been, this is the year of economic growth and inflation. Each year has been a disappointment of those expectations, because forever people believed that growth would equal inflation, and it never has. People have also believed that pumping a bunch of money into the system would equal inflation. This is a better slide than the other two. This shows you the growth of money supply, and it shows you that GDP, there was a point where it used to be back in the day when the Fed pumped money into the system, we would actually see GDP go up. So they got something for what they spent. You can kind of see the slight trend up. And then about 2000, we crossed a chasm. It seemed like no matter how much the Fed put in, we continued to see GDP fall, and the economy in general. So the Fed's not helping us at all with all the stimulus. And what he's doing is creating a pretty big drag on the economy. So this shows you M2, which again is the money supply as a percentage of GDP. That's sort of this gray line. And you can see how the money supply just kept going up and up and up as a percentage of GDP. Remember, GDP is gross domestic product. It is the value of all the goods and services in the country. So if you owned a business, your business's total revenue would be your GDP. So this is the country's revenue, GDP. And you can see as the percentage of M2, so again, money supply continued to grow. What happened here is GDP has continued to fall. Inflation has continued to fall. This slide really tells the whole story, in my opinion, going all the way back to 1959. This has not been a factor. This meaning Fed pumping money in. And in fact, it's quite the opposite. This is the Fed balance sheet. And this is why those things have not driven the economy, those things that I showed you. Meaning, here you see the Fed balance sheet going up and up and up. This is what happened during the pandemic. It was insane. But look at money velocity. It just kept falling. You can't have inflation when the money's not swirling around. So people say, well, what are you talking about? I just went shopping and my grocery bill is ridiculous. It is. Your gas prices are ridiculous. Car prices are ridiculous. But it has nothing to do with the Fed. It has nothing to do with money supply. It is, in my opinion, 100% driven by a very broken supply chain and economy. All manufacturing was shut down. Virtually all manufacturing was shut down for quite some time, but people continue to buy. If you looked at Amazon sales, et cetera. And so all inventories, everything was depleted. And then when we reopened the economy, people went crazy. They had all this fresh money in their banks and they began what I call revenge buying. I got this addiction and I got to feed it. And yet there was no supply anywhere to feed the addiction. And that's what drove prices up. That's going to be fixed before anybody believes it, in my opinion. And when that happens, you're going to see inflation fall very hard. I'll tell you, I have a strong belief next year at this time, probably before that, we're going to be talking about deflation, not inflation. This is, again, the velocity of money. So you know what that is right now. It's money moving around relative to the Fed funds rate. So it doesn't matter how low the Fed keeps pushing down rates, the velocity of money just keeps stalling. And in fact, there's an argument that the actual pushing down of the Fed funds rate is what's causing money to not circulate in the economy. The Fed has not really been helping us at all. I'm not going to read all these slides to you, but I will make them available. And I think reading them will make sense, especially, if you can remember some of my comments as a backdrop. I mean, this is the most nerdy part of the presentation, so relax. Total debt versus GDP versus money velocity. So total debt, that's our balance sheet, right? And that line is the blue line. Clearly, our debt our deficit just keeps going up and up and up. Yet the higher the deficit goes, money velocity just tanks. GDP, what used to take $1, so say $1 of Fed stimulus would get $1 of growth. You can see these lines grew together. And then all of a sudden, what used to take $1 of Fed spending would get you $1 of growth. Now it's taking $8 of Fed spending to get $1 of growth. And it's going to keep getting worse and worse and worse. And this debt burden is really taking a toll on the country. We don't feel it at the moment, but we will. Monetary velocity versus the deficit. This is just another way of looking at the same thing. As the deficit has grown, money velocity has gone down almost perfectly. This is economic growth versus M2 velocity. Once again, you can see that as the velocity, as money has gone down, the growth of the economy has gone down as well. And here's the problem. Right now, 70% of our national budget is going to defense, Social Security, and health programs. It's not going to infrastructure. It's not going to things that create jobs. It's not going things. It's like if you had a business and you committed to put X dollars into the 401k, no matter what your sales were, and the revenue was down for whatever reason, but you kept plowing all the money into the 401k, you have no money to grow your business. And maybe you took out a bunch of debt to grow, so you have all these payments. That scenario will not allow your business to grow. It'll allow your business to shrink. And that's really what's happening to the US. The interest in our debt now is 7% of our debt. 7% of our national budget is going just to make interest payments. Do you know what happens if interest rates go up another 2%? This number, it's not a linear thing. This number is going to go up maybe to 20%. Okay, so that's that. Dave, I'll call that end of chapter 1. Is this a good place to break, or should I keep going? And I know I'm going really fast, guys. I'm sorry.
No, it's okay, man. You're killing it. So if you think this is chapter 1, then why don't you stop sharing your screen? And remember, guys, anything that you think is a takeaway that you're going to bring into a conversation with a realtor, share your takeaways and your sound bites and your tweets and comments. We've got a great audience in Facebook, so thank you, guys. All these calls will always be streamed in our Facebook group, and we'll talk later about how to sign up for each of these calls if you want to be in Zoom, and they'll always be in our YouTube channel. Let's bring Tina on stage, and Tina, let's just do a 3-minute Rate Watch how-to, and let's make sure we show in this chapter of Rate Watch how to get Dan's daily updates in Rate Watch, because remember, a lot of what he's sharing, he's giving a big update right now, but he's sharing little updates every single day. And then let's show, you got 3 minutes, Tina, to give us a little Rate Watch how-to, and then we'll bring Dan back on for chapter 2.
I'm actually going to start by showing you how to get Rate Watch, because many of you might not be aware that you have Rate Watch available. So you'll want to go to your iPhone store or your Google Play Store, and you're going to search Rate Watch. It's one word, and then you will download it. Of course, when you download it, it's going to be the install, and then you can open it up. Now, remember, when you open up Rate Watch, what you're actually going to first open up is it's going to ask for your login information. Please remember your login information in there. That's the same as your mortgage coach information. So simply use your mortgage coach login and log into Rate Watch. Now, the first thing some of you guys might need to know is, what exactly are we tracking? We're tracking the mortgage-backed securities, or otherwise MBS market. And these are the bonds that are secured by the home and real estate loans. So these are going to help you be able to understand, what are those investors possibly thinking to do? Are they thinking to increase your rates or decrease your rates? Now, no, every investor does not follow directly with the MBS market. They have their own choices. Sometimes they have an agenda to push one product over another. But if you open it up like today and you see that it's green, there's a good chance that the interest rates could be seeing a small dip. If you open it up and you see that it's red, there's a chance that you could be seeing the interest rates increase. It actually works on the opposite direction of the MBS market. So if you see the MBS market going down, rates could be going up. If you see the market going up, the rates could be going down. In the upper left-hand corner, that's your menu bar. And we're going to first just go into the commentary. And this is where you're going to find Dan's information. And mine's not popping up, but you will see Dan's information in here popping up. You also might see some information from Mortgage Coach. You might see some messages from Marcy or other people from in Mortgage Coach, and they're going to let you know what's going on in Mortgage Coach. If there is anything going on that we need to tell you, you're going to get notifications in there as well. Dave, is that quick enough for you?
Yeah, it's pretty darn good. So yeah, those updates are great. And again, we'll go through every item in the menu throughout this call. We'll bring Tina back up. Dan Keller might even jump because he put a picture in our group where he was showing Rate Watch. And the one quick thing I want to say from a mortgage strategy standpoint, when you look at optimizing conversion and winning with rate shoppers, there is a strategic time where you're using Rate Watch. Dan, before you go back into chapter 2 of your slides, is there anything you want to call out from what Tina just shared, or something that you think is important loan officers have in, call it chapter 1 of the Rate Watch how-to? You're on mute.
Hey, Dan, hey, while he unmutes real quick, let me throw something in. The biggest thing I think from a loan officer perspective that I loved about Rate Watch is the ability to click the share button. So when the market's moving and you're trying to get a client to lock or trying to explain to them, you just want to click that share button and text it over to your clients or your realtors so that they can actually see what MBS is doing live. And that was super effective for me. And it's one of my favorite features of the tool.
Tina, let's make sure in the next how-to you show that. And it's also, I know Deborah's going to jump in because you can not only copy it, you can put it directly into Facebook, you can SMS it, you can email it. So we'll show you how to take a market update and turn it into one-to-many or one-to-one content. Dan, anything you want to say before we get back into chapter 2 of the market update?
Yeah, I would just add that loan officers and borrowers especially, and newer loan officers get confused about the concept of when bond prices go up, rates go down. And so a lot of times we've seen loan officers share the Rate Watch screen and it shows going down, 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 down in price. And the borrower's like, well, you're telling me things are going bad, but this says that they're going down. And you have to remind them that the price is going down and the rate is going up. And that's, it's a topic I can cover for you guys if we have time. Maybe I'll do a write-up on it just as to why that happens. But it is a little bit confusing to borrowers at first.
If you could do that, Dan, and maybe Deborah, plug and play, if you don't mind, maybe a collaboration. I'm using slang here, guys, with Tina, Dan, and you, where you create a little social media content that, nets that out in a scroll stopping, DebX way. You cool with that?
Absolutely.
All right. So cool. Well, we'll make that a homework, guys. And also anyone listening to this that uses Mortgage Coach, and if you've got some content, some emails, some things that you use to net that out, share it with Deborah, post it in our group. Let's collab with the whole community, and Deborah, in the next week or two, we'll come back with some gold. So Dan, chapter 2 of the market update. Let's roll.
All right, let me get back to sharing my screen.
Dave, is there any way that the Rate Watch could auto share to people with Lender Launchpad?
Let's take that offline.
Okay.
I mean, of course, there's a way to do anything, but let's take that
That would
offline.
be cool.
Okay, so we'll call this the potentially darker portion of the show, but please know that it's really not intended to be. It has some of that feel to it. So we talked about cycles, and just a couple qualifying comments. Number one, my group and many people that followed cycles made a killing in 2021. Remember when oil crashed and a barrel of an oil actually was negative? Actually, you would get paid if you would take somebody's oil. That was called almost to the day, not by me, but by a man named Andrew Pincelli. Andrew is the world's renowned cycle analyst. He's also on the board of the International Cycle, whatever it is, Association. We've had 3 ex-presidents in this group. It is a very real thing. It is tracked by people, paid very close attention to it. And just really quick, some history is Andrew has taken every world event, small and large, and put them on a timeline in a, I think it's 100,000 square foot warehouse, covered every single wall around the warehouse. And from that timeline created a computer model. And this model basically predicts interruptions in the force when things are going to happen. There are hedge funds that pay Andrew as much as $500,000 a year for his data, because this stuff really matters when it comes to commodities. If you're a commodities trader, it might be helpful to know, when orange prices are going to get squeezed, et cetera. So Andrew recently, when I worked on Wall Street, of course, we had the data, but it was very expensive and a company could pay for it. He's recently made it available to guys like me at a somewhat affordable price. It's less than a couple $1,000s a year. So every month I get all of the key dates they're coming and what's going to happen. And my group that follows me on options trading, the first thing they ask me now is, what are Andrew's dates? Because those dates will usually tell us when the market's going to turn in one direction or the other. We can predict gold prices. We can predict oil prices. We can now predict Bitcoin prices, stock prices. Is it the holy grail? No, it's not. It is something. It's an added tool in our toolbox. The accuracy would really blow your mind. The Afghanistan conflict, the first of the month prior to the movement into Afghanistan, the takeover, Andrew called it. And he backed it up by 300 to 500 years of cycles where there has been war and takeovers in Afghanistan. It happened almost to the day. So what we have now is 2022 is a war cycle. It is a very major war cycle. Now, just to get this off the table real quick, he doesn't think, and I don't think we're talking about a physical war. I think we're talking about a Cold War, much like we had when I was a kid with Russia and with China. If you can't see it coming right now, say, politely open your eyes. It is literally happening. And so I'm going to show you why that's happening. I'm going to tell you what that means to interest rates. So first of all, and these slides got a little out of order. I do apologize for that. November of 2021, so very recently, Barbados, which is in the Caribbean, severed its connections with the British Crown and became the Republic of Barbados. Several cycles came together during this event. Barbados is now building sporting facilities, cricket stadiums. It's huge hotel complexes. It is booming. Guess who's funding it? China. China is funding it. Story doesn't stop there. China announced it was building a $274 million ring road for Jamaica's second city, Montego Bay. China is, in fact, investing heavily in the infrastructure of all these nations. Chinese ambassador of Jamaica, Tang Kwai, spoke of greener development and told Jamaicans to get rich, you've got to build roads first. They don't have any money. So China is funding this. And then we go to South America. I'm just going to try to deal with these being out of order. I don't know how I did that. So we talked about the Caribbean, and now we have Latin America. China is making massive investments all through Latin America. They invested $315 billion in 2020. We'll talk about this more in a minute. You've heard me talk, ever since I had my podcast, Surviving the Storm. There's something called the Belt Road Initiative. So China has been, I might have to go outside and tell my dog to shut up. Sorry.
Come on, we're good with it, man. It's COVID times. We're used to barking dogs, and your dog, I know how big and badass he is, and he doesn't sound that.
No,
bad. So it's all good.
That's not Oliver. When Oliver barks.
Oh, I was gonna say that doesn't sound like an Oliver bark.
No, when Oliver barks, there's a reason, and it'll rumble the house. But
yeah, but don't worry about it, man. Just keep rolling.
That's our corgi. That's Dan Jr. And just kind of looking at these cycles, the year 2021 saw a 100-year anniversary from the foundation of the Communist Party of China. The 100-year cycle is a major turning point for China and shows huge expansion in its power across the globe. China is flexing its muscles, and most people are missing it. This event is considered to be closest to the Cold Oh, sorry. This was talking about the Cuban Missile Crisis. Again, I was a kid. I remember being in grade school, maybe kindergarten or even first grade. Kennedy was president, and Russia moved missiles to Cuba. They were strategic nuclear missiles. They were strategically placed, and it was the closest we ever came since then and before then to a nuclear war. And I remember as a kid, getting all these lessons about, fallout shelters and what to do with the nuclear fallout. And it was terrifying as a child. Turns out that was just more of the Cold War. So now when you look at these movements from China into, it's hard to see this, but this little shaded area in the bottom is Jamaica. And then over here is Barbados. And you can see their proximity to the US. There's a real reason why China is moving into these areas. They are strategically placing themselves from an offense and a defense standpoint. This is the Belt Road that they've been building, and it's now outgrown the original map. It's going all over the world. They're investing trillions of dollars. And why are they doing that? It's not just an economic play. It's not just so they can help other countries. There is a slight play in that China is very much about appearances. They don't want to admit when things are not going well. They want everybody to believe they're the fastest growing, strongest economy, and they'll do anything. They've built entire cities in Shanghai that were empty, thousands of residential communities empty, just so they could keep building and keep people working. Well, the Belt Road Initiative began when they were just running out of stuff to do in China. So they started doing it in other parts of the world. And but all these little countries, they can't pay back the debt. They now owe China trillions of dollars in bonds. What's China going to do with that debt? It's basically going to have the right to almost foreclose and do whatever it has to do to come in and use these areas for areas that they want to defensively or offensively. So, and again, this brings in a 60-year cycle. Between October 16th and 20th, 1962, the world watched with bated breath as the Cuban Missile Crisis unfolded. If I go back 60 years before that, there was another event. 6 years before that, there was another event. All of these things happen in different cycles. We talked about that one. Now, this one really bothers me. China is going to take over Taiwan, and you just got to believe that's coming, right? Hopefully it's not a hostile takeover, but it's happening. That will give China a massive monopoly on all of the computer chips in the world. Taiwan is the international capital of computer chips. Right now, car manufacturers are backlogged. Some of them are as much as 3 years on certain products because they don't have the chips. The sector accounted for 115 billion of output in 2020. If China moves into that, just imagine what's going to happen. When Afghanistan was taken over, China was immediately in conversation with them because that real estate gave them access to things that they need, like the Rawitch Straits, ways to get through for shipping, ways to fly aircraft over there that we're not going to be able to fly over there. So in 1939, Hitler commenced hostilities against Portland. We're now 82 years from the commencement of this horrific global event. Given this cycle, it's an 82 to 84 year cycle. The window for war is now open. We can take this time span further back. The Crimean War took place between October 53 and October 56. Again, 82 to 84 years.
Anyone else having Dan break up?
Am I breaking up? Okay, I got the mic closer. Sorry.
Or Dave.
Up on us, or is it just me?
I think it's just you.
So again, I don't want to beat this too much, but you can see that mathematically these patterns just continue to come together over and over and over, and they go back to the American Revolution. That's what this says here. So, oh, and I mentioned this. So China reached the Straits of Hormuz through this takeover of Afghanistan. Some would say it's a conspiracy theory. Others would say absolutely China and Russia had a role in the movement into Afghanistan. They knew we were going to get out. They're not going to let that real estate sit there. If you go back hundreds of years, Afghanistan's always been a target. People have always wanted that country because where it sits geographically. So here's the threat. Oh, sorry. These things, I'm so frustrated. I got these really out of order. I'm going to keep skipping here. So we have this 30-year cycle coming into play. We also have super long war-term cycles coming into play. Again, not to repeat all of this stuff, but there is a future set for geopolitical tension. 2022 is also 108 years on from the outbreak of the First World War in 1914. 108 years represents 3 cycles of 36 or 6 cycles of 18 years. Regular readers will be familiar with these cycles. 18 years represents a generational cycle. So the stage is set. Will we see a physical war? The odds favor an economic conflict. These two guys are not our friends. They're just not. And it's sad if anybody thinks that they are. I don't want to go out and cause fear or cause hate or anything like that. These are people that just want to flex their muscles and expand their horizons much farther than they are today. And I think their actions are sort of obvious. If what this guy's doing right now isn't really like a big wake-up call to you, you should know what's happening. And why is this happening? Forgive me, I swear to you, I am not intending to be political in the slightest bit here. This is Andrew Pincelli's words. I meant he's a Brit. He's born and raised in London. He's never lived in the US. He has no political agenda. These are his words. So why are both China and Russia flexing their muscles and extending their horizons? Quite simply because there's little counter threat. There isn't. Yesterday, Biden did say essentially to Ukraine, you're kind of screwed. It's kind of over. And then he leaked that to the media and said, what are we doing here? You guys aren't going to be here to help me. And Biden basically said, too late. We can't help you. So what happened? You know, why are we standing back like this? And this is where it gets really weird. And Andrew said this before. Oh, by the way, he predicted the election and the defeat of Trump the first time. Again, these are about time cycles. And before Biden was even elected, he said, whoever becomes the president sometime in between February and May, that president could essentially be incapacitated. Basically, whoever wins might not be very happy about winning. So just watch that. There could be something really, really important happening here. I'm not saying this to scare you. I'm saying that this is going to create some shocks in the economy and interest rates potentially to fall lower than anybody could imagine. Maybe not for the reasons we want. I'm praying that there's not actually a war, but you can see all this economic turmoil on the horizon between what Russia's doing, what China's doing. That all is going to cause fear. Fear has always rallied the bond market and hurt the stock market. So that's kind of the end of this chapter here. I'm sorry, I kind of fumbled through that a bit because my slides got out of order.
No, we're netting it out. We still got a full 20 minutes. Well, actually, a little more than 20 minutes. If it goes over a little, Todd, if you could be ready to wrap it up, or you or Deborah, because I am going to have to leave right on time. But if it goes a little over, I think everyone wants to hear what Dan thinks is going to happen with interest rates. Now, remember, Dan, we promised them what's going to happen next couple of weeks, what's going to happen next couple of months, and how do you think it's going to net out for the year? So, guys, I think we've set it up. But Tina, why don't you jump back on stage, give us another Rate Watch how-to, make sure we learn how to share it one-to-one and one-to-many, and then we'll bring you back on, Dan.
Sounds good.
So Rate Watch, let's jump in and lighten the mood a little bit before we go on. So with Rate Watch, what you want to remember is when you initially come on, this is actually going to show you Rate Watch over a certain time frame. If you click on the parameters in the upper right-hand corner, you will be able to adjust that time frame to whatever time frame you want to see, as much as 3 months to the maximum to as little as 10 days. You also have control of your coupon in here as well. So if you are not using that 4-point coupon, then you can adjust that to what you know that your agency is using, as well as you can adjust here which agency, if you want to look at the US Treasurer or the other ones, you can go in and look. Now, this is a candlestick graph. So I'm not going to go into detail on how to read it. It is pretty detailed. So just remember, if you see green, rates could be going down. If you jump in and you see that it is red, rates could be going up. Also up here is that share button that we talked about. You can come in depending on an iPhone or an Android, and you can come in and you can share it based on wherever you want to share it. On that upper left-hand corner, you can also see what exactly is happening today. Now you will notice there's a little yellow marker on my phone. That little yellow marker, that is meaning that there has been a major change, and that major change is at least 15 basis points in the market, that the market has jumped or decreased. So this is a good indicator that something's going to be happening with those interest rates. So pay attention to when those happen, because that might be that point where you want to be watching to make sure that if you are floating clients, you know, you might want to let them know one way or another, depending on the market, whether they should be looking at possibly locking or continue to float it. Again, you can control the date. If you look back on the 26th, you'll notice that we have, again, a couple of little markers in there, and it's taken a couple minutes because I'm on Zoom. So you'll notice there's a couple of markers in there as well, noting that there was that drastic change. Now you'll know that was during the conversation. Dan has a whole great piece on Facebook on why that change happened. We're going to go on down to alerts. This is going to tell me that alert today, exactly what that alert was. And we're going to go into something that actually correlates with Mortgage Coach, which is the views section. If you have your TCA views and you want a quick check-in to know which ones have been viewed today, that views is going to let you be able to quickly take a look at what happened today with your views. We already talked about the commentary. Let's talk a little bit about the lender's barometer. The lender's barometer is going to let us know, has there been adjustments in the market based on our investors? So when things do change, you will notice better or worsening prices based on that adjustment. Again, you can change the loan type in here if you need to change the loan type. At this point, there has been no investors that have changed their price. So we can see that it is even across the floor, but based on the fact that we just saw that yellow indicator, I expect to be able to see some adjustments with investment pricing in here within there. And the last one I'm going to jump into really quick before we start talking about how to leverage it with your borrowers is the market indices. What exactly is the market indices? It is yesterday's rates based on par for Freddie and Fannie. What does that mean for you if you're not familiar with that conversation? Is yesterday's average rates that closed for a Freddie and Fannie loan without paying points or giving a lender credit. So I can go in here and I can quickly see a 30-year conforming. I can see that it was at 3.792 yesterday. Again, no points, no lender credit. I can also dive into what if they had good credit or bad credit? How did that impact that interest rate? And then trending, where have the rates been? Where are the rates going? That's what Dan is going to be able to cover for us next. So I'm going to go ahead and close out and let Dan take back over.
Tina, time out. Before you do that, you never showed how to share any, and just and make sure everybody knows how to share any screen. And this feature, this share feature, is on all of the screens.
Yep, I showed it, Dave, but you must have missed it. It's okay. Up here in that corner, that little marker with the, on mine, it's a three-way. If you're using the iPhone, of course, it's the little piece of paper with the up arrow. So that is that share button that's on every page.
Cool. Yeah, my computer's been going in and out. So also, Robert, or anyone who's listening, if you could promote Dan Keller to a panelist. Dan's got a few, looks like Dan just joined us as a panelist. Todd, do plan on closing out today's call because I've got to be right on time for a 10 o'clock. Want to remind everybody, probably 10:05 or so, I'm going to be interviewing Mitch Kiter. When it comes to, being a compliance counsel, Mitch is, literally the most accomplished compliance attorney in America. No one has done more to impact legislation, the rules. And it's going to be very much a C-suite conversation around compliance, but I think any loan officer or mortgage nerd will get value from it. It'll be broadcasted in our group at 10 o'clock, and it will also be in our YouTube channel. Dan, real quick before we bring, or Dan Keller, before we bring Dan Rawitch back in, do you mind just giving 1 minute on how you use RateWatch, and then maybe in closing comments, you can share a bit more? By the way, when you do your close, Dan, it'd be great to say, hey, how are you going to use this update with Dan to be a smarter DK Keller? And then how are you going to use it with realtors and on social media? And maybe you and Deborah can riff on that a bit. But give us a minute real quick right now, Dan.
Yeah. One of the things that I think you and I were talking about the other day, real quick, Dave, was I was showing you a picture of my phone and what I do. And that's why we have Deb here, because Deb's going to probably polish up what I'm explaining. But I'm just a former jock and a mortgage guy, right? But what I do is I'll just go into Rawitch, and this is helping me a lot with conversion with new clients. I'll go right in here to Rawitch, the Rawitch app. I will take a screenshot. So I'm an iPhone guy. I take a screenshot. Okay, so it takes a screenshot. Then I drag it or I pull it into Instagram stories, and I just literally edit it. I can type a couple things. I can circle, draw a line, and then I screenshot that, and then I send it to the customer. And I'll tell you what, it's 30 seconds or less, and it's probably helped me win 2 or 3 deals right now. We're up here in Seattle, and it's the banks and credit unions are buying the market right now, and we got to be advisors, and this is helping me. So I reached out to you the other day, and I actually sent you that photo of me sharing it, and you're like, hey, can you jump on? And so happy to share that. But Deb, I don't know if you want to polish that up, in a little while, but that's what I'm doing.
Will you send me that too, Dan? That screenshot?
Yeah.
Yep. And so remember, guys, you can do what Dan said, screenshot. And Tina, it might be a good idea to tell the product team, maybe we do a little, save that to file. So it's a little even sexier looking image. Right now we have email, SMS, Facebook, copy to clipboard. Copy to clipboard is pretty cool because then you can have it, it's like cut and paste. And now you can paste it into an email. And maybe we'll even add a little, that screenshot's easy to do, but maybe we'll put a button in there for you. So guys, I'll let you guys wrap that up. Dan, let's come back on and remember the promise. What do you think is going to happen next 2 weeks, next 2 months, and by the end of the year? You're up, brother.
Dan, you might be muted.
You are muted. Remember, guys, if you have questions, put them wherever you're watching this. If you're watching a recording on YouTube, we'll get your questions answered. If you're watching this live, Todd and Deborah will make sure we integrate them into the conversation. And you're up, Dan.
All right. Sorry about that mute thing. Okay. So just kind of closing up on some of these cycles.
We're not seeing your screen, Dan.
Oh, gosh, I thought I did that. Okay. Come on.
We
All
hear
right.
you and we see you. Right on.
Yay, finally. Okay, sorry. Okay, so just talking about cycles, it's interesting. This is 120 years of data for the Dow Jones. And going back that many years, years that end in 5 are extremely good for the stock market. We're now in a year that ends in 2. So it's mildly bullish. And this kind of tells you, how things will go going back as far back as you can with the Dow. And still sticking with this cycles. And now I'm relating a lot of what I've said into actually market data. So this is just an example of a 20-year cycle. And you can see that in 2002, the Dow Jones kind of peaked in January 4th, and it sold off considerably going into February. Does that sound kind of familiar? This is real time now. This is January 4th. Okay, let me just take it back here for a second. January 4th. And this is what's happened now. And so this would argue that this sell-off could continue maybe until February 7th. But we have many other cycles that we watch. But this 20-year one is sort of important. Here's an 80-year cycle, January 5th. Again, you saw that X on my other chart. This is where it topped out. And then we went into a very long fall into April. That's an 80-year cycle. Here is a 45-year cycle going back to 1977. Again, we peaked on our route January 4th. This time it was January 3rd, and we sold off well into March. So these things do absolutely repeat themselves. So I want to talk a little bit about what the Fed thinks. I'm going to go through these pretty fast because I get what you guys really want to hear about. The Fed thinks that inflation is going, this is 21. So you can see that their forecast was to be kind of mid fours. 22, we're talking about going back into the twos. 23, low twos, and 24 into the high ones, high twos. So by the Fed's own math, this inflation is peaked. It's moderating. It's going to moderate, and we saw that today. We PCE, which is the personal consumption expenditures, was released this morning. That's more important than CPI. That's the inflation number the Fed watches. It dropped from last month. So, and that was the second month in a row. So we may actually be seeing things moderate. The Fed's belief about GDP is it's going to continue to drop. That 2022 is going to be worse than 21 and 23 is going to be worse. Now, I want you to think about this. He said on Wednesday that the days of an accommodating Fed are over. Don't expect it. And that he believes the employment picture. I watched the minute he said it. I was chatting with all of my members and I was listening to him and he did a pretty good job. The market was doing well. And then a reporter asked the question, do you think the employment picture can withstand rate increases right now? I could not believe his answer. A simple yes would have been just fine. Maybe even a yes with some color. We're comfortable with the employment. He said, yes, this is potentially one of the strongest job markets we've seen and can sustain many rate increases, perhaps even many more than we intend on doing. I typed in that minute, watch. And all of a sudden, the NASDAQ went from up 300 to down 300. It happened in minutes. And the same thing happened with rates. Why he decided to be so hawkish, I really don't know. But I can tell you he's wrong. He had no right to make that prediction because he doesn't really know the future. And his own Feds are predicting a slowing economy. You guys, if you've been with me for any time at all, I've shown you that every single Fed cycle where the Fed starts increasing, we go into a recession. Every single time the Fed thinks he needs to start raising, or they take us right into a recession. And we're already headed in the wrong direction. These are the Fed members. You guys have heard of the dot plot. The dot plot is the stupidest thing that ever was invented. I don't know why the Fed keeps doing their stupid dot plot. Each dot is a member of the Fed, and it tells you where they think rates are going, by year. And so you can see that most of the Feds think the Fed funds is going to kind of be in the 2% range. It's currently below 1%. So they're calling for about a 1% increase. And then going into the following year, the majority of the Feds think we're 2.5. So the Feds are seeing a slight increase in Fed fund rate. Okay, I want you to think about this. This is going this way. This is going this way. How stupid is the Fed? Why would you predict a declining economy and in the same sentence predict raising interest rates? It is so illogical. It disturbs me. I think I cut this one off. Would I do that? Okay, we're gonna skip this one. Did I cut all of these off? Okay, so this is actually the Fed's belief on inflation. And so, I see, I remember now. So this one is, oh, damn. So this is the Fed's take on inflation. Each one of these are different Fed members. In this case, a lot of Fed members believed that inflation in 2021 would jump. This is what they believe for this year. Most of them believe inflation comes down by almost half from here to here. But if you actually add up all these guys, most believe we're talking about inflation rate kind of in the 3% range. Very few are up in the 4% range. And then 2023, they're all predicting inflation in the 2% range. Yet we're going to keep raising rates into a declining GDP and a declining inflation picture. Do you guys see the nonsense here? And then this is a longer run beyond 2024. They're seeing deflation. And yeah, they're right, but they're not right about this part. I think a year from now, we're going to be talking about deflation. I think I'm going to kind of get through. I think those slides probably made the point. I don't want to
Hey,
just
Dan, I want to chime in because I'm going to leave before Todd does the wrap up and everything. But so guys, stay on, listen to Dan's final thoughts. But here's a couple things I know for sure. If you want to have a client for life business, you need to be essential. You know, for the past few years, whenever I do a social media post, you'll see it says mortgage coach. And I've either done be the best or be your best. My word for 2022 is essential. You want to be essential to your clients. And here at Mortgage Coach, we want to be essential to you. You know, and it's also a new day at Mortgage Coach. Mortgage Coach, you know, with our investment from LLRs, which we have shared publicly, you know, you've seen the press releases all week, is, you know, this community now is Mortgage Coach and Sales Boomerang. And it's all about making you essential so you can be a client for life loan officer. So one last thought, you know, Deborah and Tina, it would be great if maybe you guys collaborated, and when you come out with some of that social media content, if maybe you just did a call and maybe you had Dan Keller join you and the three of you, you know, talked about, hey, how can Rate Watch make you essential? How can Rate Watch help you be the light, help you be the source of content? Because right now there's a lot of, you know, mainstream media. I don't listen to it. You know, I listen to bloggers, I listen to podcasters, I listen to Dan Rawitch, and that's where I get my news. So, you know, make sure you're following Dan. Dan will tell you in a few minutes how to follow. He's got a platform, Market Mentorship, which if you want to really be a market nerd, where he not only shares his perspectives, you know, more deep, instead of it's 5 minutes, it's 15, 20, and you can ask him questions and interact with him, and he even gives stock picks. You know, make sure you check that out. But Dan, you rock, bro. I appreciate you. I'm going to let this go. I'd budget, guys. This is going to go at least 5 minutes over and maybe 10, but I'll let Todd kind of control how long the call goes. So Dan, you're killing it, bro. Appreciate you, man.
Thanks, David. If we don't talk again, I know I did text you this and email you. Congratulations on your new business partnership. It's huge, and I can't wait to see the levels it takes you guys. It's just going to be amazing.
I mean, there's no doubt we're excited for Mortgage Coach, but we're more excited for you. If you're a local referral-based mortgage professional and you want to be the captain of the wealth team, you want to be essential, and you want to be a client for life loan officer, we are the magic ticket. So make sure you guys check out both of those. And if you're not already a member of one or both of us, you know how to do it. Mortgagecoach.com, get a demo, salesboomerang.com, get after it. Take care, y'all.
Yeah, and just add, you know, one more thing. I just thought about it after, you know, Dave talked to me about this, and think about a great company that's had good capital now having virtually unlimited capital and what they're going to be capable of. It's a little scary, actually, in a good way. Okay, so one more conversation about cycles, slightly different this time. We can use time cycles almost like sound waves, and they have a very predictive nature to them. And I just wanted to show you the cycle correlation real quick, what this means. So I'm going to predict going 90 days out the direction of TLT. TLT is a fund. It's like buying. You can buy it just like stock. Type TLT into your, you know, Schwab or whatever account, and it pops up like a share of stock. But the only income it makes is it invests in 10 and 30-year bonds. It tracks interest rates almost perfectly. So we use this very often, more even so than mortgage-backed securities or the 10-year bond. So what this is telling you is if you look at the 40-day time cycles, so basically every 40 days, they top and they bottom. The question is not whether they go up or down every 40 days, it's the amplitude. How high do they go and how low do they go? That, what I'm about to show you, has a 92% correlation. It's been 92% correct going back over the last couple of years. Pretty accurate. Then I'm going to show you the 100-day time cycle. So every 100 days, again, thing goes up, things go down. It has to do with what's the amplitude. That's about 90% accurate. And then the 200-day, of course, as you go further back, it gets a little harder to predict. So that I wanted to give you that as a backdrop, and this is not going to thrill you, okay? But you need to be prepared. So the black line is predictive, and the candlesticks are what actually happened. And this is important because you can see this black line is telling me 90 days out what's coming. And so if you look back, you can see it don't lie. I mean, you kind of want to believe this line. It is, you know, we trade on this type of information. It is incredibly accurate. And it's telling a slightly negative story here. What it's telling you is we will see some more downward pressure on bond prices, meaning rates will go up. And this takes you up through March, through February. I'll give you a better look at that in a second. I don't know what happened to all my dates. See, this is October, that's 4 months, this is 3 months out. So this is through February. You'll get a nice bump in March, taking us, you know, about halfway back to where we are today. And then a decline into the middle of the year, and then we start climbing out of it. How much, I don't know. I can continue. We update this every day for our Market Mentor members. It's extremely helpful. And how this kind of gets derived is through the spaghetti down here. So each one of these lines represents a different time cycle. So the purple line is the longest period of time. And going back as far as you want, almost to the day, the purple line peaks at the same time period constantly, and it bottoms at the same time period. So we know when this cycle is due to come up on the long term. And then you have shorter term, and then the skinnier lines are really short term. And when you put all that together, you get this black line. That's all this is. Because this is a little hard concept, a little tough to understand, but if I take every single time period cycle and I blend it together from, let's say, a 3-day period to a 200-day period, you get the market. That's really what the market did, and it's really what the market's going to do. So that's how this works. Next, what the heck? Oh, wait, is that supposed to be there? Let's forget that. Okay, next we have seasonality. And oh, I'm so frustrated. What did I do on my slides? I mean, I think I actually go back to the data. I did not realize I cut these off so badly. Well, I'll just cut to the punchline. This is 15 years of data, seasonal data. And what this tells you is essentially every year about June, now this is price, so this is good. This is what we want to go up. Every 15 years from June until August, things get good. This shows you that from March going into April is good. And what I cut off looks just like this. It's going down. We're in a very down cycle seasonally. And if we have time, I might just pull it up in real time from the website. But this correlates well with the time cycles I just showed you. This is using pure seasonality. We do extremely well trading. I can type in any top stock ticker and I can see I will pick stocks that have been 90% of the time go up during a certain time period. You know, that's how we increase our probability. But what's important here to note is only 28% of the time during this current time period that we're in has the price of TLT gone up. So meaning 72% of the time rates go down, rates go up during this time period. And if you were investing in TLT as a stock, you would have a negative return going out for the next 30 days. And then the last thing, which many of you have heard me talk about, this is called Elliott Wave. It's a very complicated math, and it's beyond my ability to even calculate. There was a time where I was able to do it, but that was 40 years ago, and when I was on Wall Street. Now there's software that does this. And what Elliott Wave does is it looks back and it calculates, for instance, how long did it take to go from here to here? So the time and how much, and then how long from here to here, how long from here to here, how long from here to here, and it goes way back in time and it calculates these waves. The market moves in waves. You have up waves, down waves. Waves always come in cycles of 5, always. And so the current wave cycle peaked in, is that December, mid-November? That's when things kind of start getting ugly. This is the current cycle. And what that did is it started this, what we call a diagonal cycle, which is again, five wave counts. And it's not pretty. So currently, and this was predicted here. So when this was here, I already knew we were probably coming down into here, and it was pretty accurate. And then it predicted where we would come up to here. Well, the next one comes all the way down here into March. Then we get this, kind of jump into April. This matches the seasonality almost perfect. And then potentially, if nothing else changes, because things can change. In other words, this could come down and maybe not come all the way down here. And if it doesn't come all the way down here, it'll overshoot this and could come up here. And then this may not come all the way down here. It may come down to here. So again, it all has to do with where does the next wave end? And that'll determine where the next wave goes. So the next wave is a bit of a doozy. It'll take you down about 20 points from here. But that wave bottoms in June, and then things get really good. And once again, that matches the seasonality data pretty darn good. So what does all that mean to me? It means that the next 60 days, you kind of want to be prepared for the worst. And you probably want to take any rallies in the bond market as opportunities to lock and really go get some clients. And because what I want you to remember is when things are on the way down, you still get up waves. Things don't, it's never linear. It doesn't go straight down. You get these wave ups. And this is how people lose money in the stock market. They say, oh my gosh, it's recovered. Yay, this is so awesome. Not realizing, no, just this wave is only going to come so high. And then the next wave is going to crash down harder. So take these waves as an opportunity as they come. I do my best to call these waves as I see them. But the current picture, it is a little bit bearish. And I think that's very much Fed induced. And I wasn't surprised. I told our members when this time cycle wave started coming down here, this was Wednesday, this was Fed day. And I said, this lines up a little too eerie for me because the Fed's going to speak on this day and he has the ability to really do this. So that's it. I mean, I would just say, let's not let opportunities to lock get by us. But no, just tie it all together one more time. Sorry, Todd. Think about what I said about the economic, I'm going to call it economic war, not a war. Think about the fear that's going to come into the market as Russia moves into Ukraine, as China takes over Taiwan, as people become more clear about what China is doing in South America and the Caribbean. It's going to put some fear into the markets. And I hate to say it, but fear is the friend of bonds. I've always said we're the undertakers or the morticians of the economy. I mean, we do really well when the economy is doing really poorly. Historically, when the economy's done poorly, we killed it on refinances, but we did terrible on purchases. This is different. This housing market is unlike anything I've ever seen. And I did predict the last recession almost perfectly. And I did say, guys, I believe that the housing market is going to be immune to the next recession. And it was. And now I think it's obvious, right? We have this supply problem that's not going away. We have a demand problem that's not going away. The millennials are just going to keep buying. It would take a recession so much deeper than anything I could ever see coming to disrupt this housing market. I don't think it's going to happen. So I think that the second half of this year is going to be unbelievably good. And I think the first half, guys, there are so many cash out refis out there. It's ridiculous. There are lists you can buy that you can specify how much debt you want the consumer to have, what you want his debt to ratio to be, the amount of credit card debt, their payments. You can buy lists that specify all of that. And do you think that consumer that's buried alive, I have a very good friend, might even be a family member, that has this kind of a credit card problem right now. And a problem with the roof. And she would do anything right now to be able to get a HELOC. She doesn't want to get rid of her loan. I don't think she's going to qualify for HELOC, so she's going to have to refinance. She doesn't care if the rate is is 4.5 or 4 because she's going to save $2,000 or $3,000 a month by getting out of this debt problem she's created. So just remember that they're out there. There's millions of them out there. Just don't sit there and wait for it to fall in your lap. That's all I got.
All right, Dan. So there's well, first off, just love it. Thank you as always for sharing. And so as we kind of see this screen with rates continue to get worse through June and then getting a pop. At one point, you said that maybe you could see rates actually getting better than they were in the future. Do you feel like in the June pop that rates are going to be as good as they are now, not quite as good, or could they actually be better? What's your thought there?
Yeah, no, I think June we see a better picture than we have today. And I see that picture improving into the end of the year. And I think going into the end of the year, we'll see the pandemic lows. That could take into 2023. But that's based on where GDP is heading all by itself, right? You saw the Fed's own math. And then what happens when the Fed raises rates the next 3 times on top of a declining GDP? It's happened every single time the last 7 recessions, like clockwork. So yes, it is going to happen again, and you can thank the Fed for it. I think we're very low rates.
I love that. Hey, real quick too, where can people go if they want to sign up for your market mentorship program? Is it just marketmentorship.com or something different?
Yeah. Did you happen to notice at the bottom of every slide?
Well, now that you mentioned it, I do notice it. All right, perfect. So that's where you guys should go if you want to register. And then last thing is if you can give a brief thing, what do you do for the loan officer sitting here going, oh crap, Dan says it's going to get bad and I've got all this money sitting in my 401k invested. Do you have any suggestions or advice there, or you're not allowed to do that?
Well, yeah, I mean, technically, I'm not a financial advisor, but selfishly, I would say, well, Market Mentor is a place to start. It's extremely inexpensive. We do give weekly stock picks, and as of last week, we've had 1 losing week since we've been tracking, and up year to date. Sorry, not year to date, but annualized over a 12-month rolling period. We're up 139%. So, it works. And then we have University of Options, which we actually teach people how to read charts and how to know what's coming. Beyond that, it's a little hard just to say what to do, but defensively, believe it or not, I think TLT is going to be an amazing investment coming into about June, maybe sooner, because bond prices are going to accelerate because rates are going to go down. Goldman Sachs just raised their forecast for gold to 2,100 an ounce. So gold and silver are going to be a really cool place to hang out. And then there's something called the VIX. The VIX, it's a symbol as VIX. You actually not the VIX. You can't buy shares. You have to buy options. So if you don't want to learn how to buy options, then VXX is a stock that goes up when the market goes down. And so I would think that any portfolio right now, if you're not on the sidelines, you want to be holding some shares of VXX personally.
Love it. Love it. All right. Well, we are so grateful, Dan, for all you do for our community. Appreciate you so much. I can't encourage you all more as someone who's been a member of Dan's program really since this whole health situation started. And it's given me a little peace of mind with my own portfolio. And I'm too busy. I don't do all Dan's trades. So apparently I should be now that I'm hearing them, because I'd be a whole lot wealthier if I had. But nonetheless, I've gained so much and made a lot of money from following Dan. And I would encourage you all to do that. It's inexpensive and it's a great education. And I think that really my action plan would be to go back and watch the slides and figure out how you as a mortgage advisor can give better advice to your partners and clients based on what you've learned from Dan. Your whole goal should be to be able to talk a little more intelligently about the market so that you sound like you know more than you do. That's what Dan does for us. He makes us sound smarter than we are. And I would just really be thinking about, what preparations do you need to do? When I hear Dan say, hey, rates are going to go back to pandemic lows, that makes me think my database, what do I need to be doing now in my database to prep them with what kind of scripts and what kind of drips do I want to do to them? So when rates do drop, that we're there. And then obviously he pointed out what the low hanging fruit is right now, cash out refinances. And so as always, I would take action. You invested more than an hour today in watching this either live or on YouTube. If you are watching it there and you enjoyed it, give us a like, give it a share. That'll help our metrics. Any last words, Dan, before I close us out?
No, one more thing, actually, because again, being a loan officer, the first part of my career, and then managing loan officers and owning mortgage companies, loan officers do have an innate tendency to sell what they don't have. I don't know why we do that. We do it mostly when rates first go up. It's like we're embarrassed to talk about what's real and we want to talk about what we had yesterday. Don't talk about what we had yesterday and don't talk about what we might have tomorrow. You really have to sell what's here and now, because when you look at this chart, you can see that there is a fairly random nature to this market, and that anybody that, you know, perhaps missed out here because they were upset because they didn't get way back here when it was up, look what's happened to them. And that's why these charts are so important to use, the rate watch charts, because they remind people that nothing goes straight up and nothing goes straight down, and you can't always time this perfectly. So take what makes sense today.
I love it. I love it. People are asking who came late if they can watch it over again. Yes, it will be posted in the Mortgage Coach YouTube channel later on today. We will have it all for you. And as always, Dan, you crushed it. Thanks for making us all better. Appreciate you. Thanks behind the scene, Robert. So on behalf of Dave and the whole crew at Mortgage Coach, myself and Win by Noon, and Deborah Bird and info, plugandplaysm.com. And of course, Dan Rawitch and marketmentorship.com. Thanks for being here. We'll see you guys next week.
Thank you so much, Todd. Bye, everybody.